Hey everyone, it might feel like there's a lot of pessimism out there, but our next guest started a fund called the Optimist Fund, and he's taking some big swings at companies that people might call pretty risky. He's a new kid on the block that has pretty impressive returns, especially when you consider he started his fund in one of the worst times ever for the tech market in 2022. Since then, he's clawed his way back, and it's on the back of some pretty wild moves in the market. We're going to talk about what those are, and as always, he gives his three best ideas, names that he thinks can double, triple, even quadruple from here. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. Investing can be intimidating, but it doesn't have to be. With BMO InvestorLine, you have the tools and resources you need to make informed decisions and build a successful portfolio. Their easy-to-use platform, packed with research tools and commission-free trading on over 100 popular ETFs, can help you take control of your financial future. Learn more at bmo.com/online investing. Jordan McNamee of the Optimist Fund, thanks so much for joining me.
Thanks for having me.
So this is actually our first time speaking.
It is.
So we're going to have to develop this rapport pretty quick.
Yeah.
Optimist Fund, we could all use a lot of optimism right now. I would say with tariffs, with the markets behaving the way they are, optimism is probably not the word that first comes to mind. Talk to me about what is the philosophy behind the Optimist Fund.
Yeah, so we are focused on investing in great CEOs that run fantastic businesses, have proven track records, and that have a lot of growth opportunity. And that, most importantly, has to be really underappreciated by the market. And so I named it Optimist Fund. Like, people ask me, why is it Optimist Fund? I named it because looking at businesses that have these traits, think of like an Uber, for example, or other digital disruptor that has built a very large business. It's very difficult to invest in these type of companies if you are a naturally pessimistic human being just looking for flaws, because there's going to be a bunch of challenges that they need to overcome in the journey to becoming that business. And so what I realized is that every really successful entrepreneur that builds something really big, every very successful investor that has investments that are, 10, 20-fold returns over time, they always have this layer of optimism, and that's something that I was passionate about, and so that's why I went with that name, and that's how I'm every company I look at. Like, I don't think I'm being some sort of irrational optimist. I feel it's always realism, but when I look at something and someone says that company is crazy, I always think, what would make it not crazy? Like, how would that business model completely make economic sense and be highly profitable? And then when I play that like counter narrative, all of a sudden you can realize, maybe that actually is a really good business, even though everyone's saying, oh, they're burning cash, it's a bad business. Maybe it isn't.
Well, I think that's really fascinating. Pessimists, I think, sound really smart, but optimists often are the ones that make money. And that's the camp that you want to be on. It's one of the reasons I became a financial journalist, because you get to talk about making money.
Yes.
Whereas the other stuff is like, it's a lot of fires and murders and things like that. So with that in mind, how do you think about companies working when the macro environment doesn't seem super supportive?
Our decision to invest in a company is never driven by what we think the macroeconomic activity is going to be over the next year. We're looking for businesses that are going to generate a lot of profit over the next 5-10 years. And so if we have a dip in GDP in Q3 or Q4, like, that's not going to be the relevant element as to whether or not this is a really successful long-term investment. Like, because 08, 09 happened, like that didn't make Amazon good or bad. It was getting the business right. And so we use it more as an opportunity to find dislocations. And so we started in 2022. Like, this was a horrible time for the macro, and a lot of companies were getting slaughtered, to put it lightly. But but it was things that weren't going to last forever. And so we took advantage of that and bought a lot of businesses that were down 80% in 2022. And since then they've done exceptionally well. So that's more how we think about it. We want to get the business right and the people right. And we'll use the macro as the opportunity to get good prices.
You can talk about your returns. What are your returns since then?
Yeah, so we just hit our 3-year mark and we've compounded at 17% net annualized returns. So it's been good.
And have you made up for the big losses that you experienced in 2022?
Oh, of course. Yeah. Well, to get 17% net, you gotta do that. Yeah. So if anyone wants to know a crash course on how not to start your fund, I think I could speak for an hour about that.
Get into it.
In 2022, like some of my largest holdings were Uber, Carvana, and those companies went down significantly. And so we were down 50% in 2022. And then we doubled down on a lot of these positions that were really great businesses run by really smart people that were not going away. And in fact, we thought getting better. And in 2023, we were up 83%. 2024, we were up 67%. And so that's how you get to the 17%.
So you're kind of a new kid on the block. You've got your first fund, just yourself. And I know you worked in portfolio management before, but this is your very first fund, new kid on the block. And then you step into one of the worst markets that we've ever seen for your style of investing.
Yes, that is correct. There was like probably 6 months over the last 30 years that would have been a worse time to start the fund. So yeah, it was tough.
How did you hang on? How do you not close up shop after that?
Because I knew we were going to make a fortune on the other side. Like the whole purpose of the fund is to generate exceptional returns from really deep research. Like knowing your business is much, much better. That's why the fund is so much more concentrated. Like our top 10 holdings is 80% of the fund, right? So we're incredibly focused on a few things that we think are going to make us a lot of money over 5 years. And so it sucked at the time because it just resulted in me having to explain why I'm not an idiot or something. Is pretty much what it was. But now the good thing is when you explain that through 2022 and those tough periods, now people that heard me at that point are like, oh, okay, this guy actually knows what he's talking about and was saying things that were incredibly unpopular at the time.
But when you're talking about those concentrated positions, that's a very small set of companies to have a large percent of your portfolio exposed to. So do you get labeled the risk guy, the risky guy?
I think the surface level, the people definitely would label me as that. I don't believe I'm that at all. Like everything I've built in my life is tied to the success of the fund. So by no means do I think I'm like investing in some sort of unproven business model. But I think that's the arbitrage opportunity. One of my investors I had dinner with the other night, and he was talking about like how I like predict the future. And that's not what I do. And that's not what I'm focused on doing. What I'm doing is finding stuff that's happening right now that people misunderstand. And so there could be a business right now that has a division in St. Louis and a division in Miami. And the St. Louis business is 6 years old and it's minting money, doing exceptionally well. And the Miami business, they opened last year and it's losing money because they're building it up. And people could in aggregate then say, oh, that's a bad business. Look at the aggregate. St. Louis and Miami together are losing money. It's a bad business. This sucks. But then if you unpeel and figure out, oh, St. Louis is actually an awesome business. And Miami right now is loss making, but it's actually on a better trajectory than St. Louis was. Then you could be like, holy, this is actually like a really good business. It actually works. And everyone's saying it sucks. And so that is more like, I'm more trying to find what's working now that people don't appreciate. What's a great business model now that can scale and keep getting bigger. And then people are going to realize, oh, this thing's going to mint money.
It also means that I imagine you're doing a lot of this diligence on how many stocks? Thousands?
I
guess I'm trying to get at like, how difficult is it for you to pull the trigger, right? Like how selective are you out of the hundreds or thousands of names that you look at and do this kind of diligence? Like how many are you actually executing on?
Very few. We have 16 holdings right now. So 16 holdings and 10 are 80%, right? So we have 6 smaller positions in businesses that either I have less conviction in today or the price just isn't quite as attractive as the first 10. But like I've reviewed probably in thousands. But it has to be, I got to think the CEO is awesome. Like I can't, one thing I've realized is like, if you are like, this is a great business, but the CEO, I don't think is smart. Like, tariffs will happen, something will happen in the economic environment where stocks will go down a lot. And then because of you not having trust in that CEO, you're not going to have the conviction to then add at the best moments. But if you do have significant confidence in the people running the company, in the disaster moments where everyone's just selling and terrified of the markets, you have conviction to actually take advantage of it.
Isn't that a soft factor though? Like, how do you get that? I mean, are you cozying up to the CEO of Uber and all these other companies?
For some of the companies I own, I know really well, and I've known them for many years. A lot of it is just auditing who they are, what they've done over history. That's really the most important element, is like listening to what they said in 2017. And what happened, and what happened in 2018, what happened in 2009, and what happened. So it's getting comfortable with them as business operators, and coming to the conclusion that like this person is exceptional and they have their life's net worth in the business. So they're incredibly incentivized.
That's super interesting. We're going to talk about some of these specific stocks, but I also want to talk about what makes your fund unique. Yes, you started at one of the worst times to ever start a fund. And I wonder if one of the reasons you're able to hold on is because you had the backing of two prominent investors in Toronto, Sanjay Sen and Jonathan Bloomberg of Bloomberg Sen. How did that come about? How does that partnership work?
Yeah, so I met them in 2020. I previously worked at CI Financial. There was a group within CI called Cambridge Global Asset Management. And so I worked within that group and I was managing a global small cap fund. And one of our larger holdings, Great Canadian Gaming, was also one of the larger holdings of Bloomberg Sen. And so there was a corporate action going on with that business that brought us together in a discussion. And that made me get to know them as people. And my goal was always to start my own fund at some point in my life, because I want to put up exceptional numbers. And it's really hard to do that in a typical corporate structure, I would say. And so I pitched them the idea to help me build a business, and we got to know each other over the next year or so after like me initially pitching them the idea, and then they were sold and said let's do it. And so they've been an incredible partner. And to what you said, like that is true. Like it would be very difficult to take advantage of a lot of the market turmoil that happened at the end of 2022 if my partners were not who they are in terms of like independent business owners. Because there would have just been so many other pressures telling you to like make short-term changes that would not have been beneficial to long-term returns.
This year, the tech sector is underperforming, and I know it's only March, so it's a short time horizon. But are you worried we're in for another episode of 2022?
No, I'm not. Is it possible? For sure. But 2022 was a great thing for Optimist Fund shareholders, to be clear. So if there is some craziness that happens in the market because Trump tweets something else that's insane, like we'll take advantage of it if the opportunity presents. And so that's not something I really worry about. If anything, I'm actually quite excited because people are getting so pessimistic, and that's when you can get some like really, really attractive bargains that make you a lot of money.
All right, well, let's see if we can find them and dip into the mailbag. Okay, our first question in the mailbag is about Uber. I want to know about Uber as a long-term hold.
Yeah, so we own Uber. I vividly remember the first time I took an Uber and was just blown away with how great of a customer experience it was. And so that ignited my interest in the business. And then in 2022, the business sold off significantly from its 2021 highs and was trading at an exceptionally attractive valuation. And the business was at this point where now they have effective market dominance in everywhere in the Western worlds. And the incremental growth is flowing to the bottom line at an exceptional rate, which is going to make everyone realize, oh, Uber actually generates a ton of cash. And so over the last 2 years, what we've seen is this consistent, strong growth, really high incremental margins. And I think that's going to continue for a long time. And Uber could be, today it's about $150 billion market cap company. it's one of the few companies that could be $1 trillion company at some point in the future.
And so what gets it there? You mentioned what's gotten it to this point. Now we're talking about a future that involves robo-taxis. Like, how does Uber play in that? Is it a disruptor?
Yeah.
Or could it be disrupted?
So there's always risk, of course, and the robotaxi element is like the newest topic that is the concern. The topic used to be, are they ever going to make a lot of money? Now they've proven they're making tons of money. And so now it's, okay, well, are they going to stop growing in some way? And so is it the robotaxi element? And so Waymo is really the biggest threat today because they're the only one in market in any material size. And Uber has taken the partnership element, where they are the distribution partner actually for commercializing in Austin, which just launched recently. And then their Waymo's cars are on the Uber app in other cities. And so is there a scenario where all of a sudden Waymo dominates the entire world and there's no need for people to be actually driving vehicles? That is a very, very long-term thing. It's possible, but there's a key reason why I don't think that's going to happen. And it's that the demand for rides is not, it's not like steady throughout a day or steady throughout a year. And so the common notion of like cars are only utilized 5% of the time. And so they could be utilized 20 times more. And that's going to make it so pricing comes down. That's not really in reality, because they would never be used 100% of the time, because most people want to use a car at the same time. When they go to work, when they get home from work, when they go out to dinner, these periods of time are when there's a lot of demand for vehicles. And so Uber's, if you were to have an autonomous fleet address that, you're going to have way more vehicles than you'll actually be using throughout the day. And that's why Uber's existing network of people who already have vehicles entering the fleet with a sunk cost, which is their car, is very economic. So I see it as a hybrid environment over time, where there'll be autonomous fleets in major metropolitan areas, and then there will be a lot of Uber drivers filling in the gaps as well.
What do you think about Uber Eats and the role that it plays in getting Uber to $1 trillion company?
It's going to be important. So like one thing that's interesting to think about is how many things do you think are delivered in an hour? Like if we think about like e-commerce and how much is like delivered in 2 days, how much is delivered in 1 day, how many e-commerce transactions are delivered in an hour? Right now, it would really just be Uber Eats, DoorDash. It'd be food. It'd be stuff that needs to be there in an hour. But that has expanded because Uber Eats and DoorDash have realized, oh, we have this like network for on-demand commerce that we can apply to other areas. And right now, you might not care about getting like, I don't know, getting a basketball net from Canadian Tire in an hour. That might not be a demand that you have today. Just like 20 years from now, buying something on Amazon and getting it next day was not necessarily a demand. But over time, I think that the desire to have things faster is going to be increasingly important, and that's very beneficial to Uber.
So let's link that with our second question, which is DoorDash. Are you a fan of food delivery companies like DoorDash, which, by the way, is down about 12% from its recent high?
I am, and it parlays on to the Uber comment of that both of these businesses have built up on-demand networks that are incredibly valuable and still utilized in a very small fraction to what they can over time. And so if you want to buy something in an hour and get it delivered in an hour, the people who are going to do that are these on-demand networks, and DoorDash and Uber are the 800-pound gorillas in those industries. So
you're bullish on this sector, and you don't mind taking exposure to both. You didn't kind of rank them and pick a winner.
Yes, I like both of them. They both have their different exposures. So obviously DoorDash doesn't have the rideshare business, and it's really just a commerce business. And then it's also the metro areas in which they hit are quite different. So DoorDash became successful because they were a suburbs-based business, whereas Uber's Eats just leveraged the rideshare business, which is metro-based. And so they actually are dominant in different areas, and I like both of them and think both of them will be much larger companies 5 to 10 years from now.
Shifting to retail, we've got a question on Revolve, which I know is one of your holdings. Do you like the luxury clothing site, and are you concerned about the impact tariffs may have on the consumer? Revolve is would you say it's sort of a different beast when it comes to retail, or it's got sort of like a edge to it?
I would say, or I wouldn't say it's luxury. I would say Forward, which is another site that they have, is more luxury centric, but I would say they're more like in that like Aritzia price point of like everyday luxury. Tariffs will have some impact to them. I don't expect it to be material, to be honest with you. If you look at the history of the business, they've grown revenue at a 20% annualized rate for over 20 years. It's run by two guys that own 45% of the company and are really strong entrepreneurs. And they had a really, really good time coming out of the pandemic where everyone wanted to go out and everyone was buying new clothing. And then the last 2 years has been really tough, frankly. And they went from growing 50% to declining. And now over the last year is finally when the business has started to reaccelerate. And so that reacceleration process is still happening now. And I think that is going to be more important. If tariffs knocks a point or two off of their growth, I don't think that's going to be the important thing. It's going to be them getting back to 20% revenue growth is what's going to drive the stock.
What about the fact that, I'm curious when you got into it, because it's one of those stocks. There's a lot of tech-like stocks that recovered their 2021 highs, went on to make new highs. Revolve's not one of them.
No,
it's still
not.
Kind of a shell of itself from 2021. It's down a bunch from its November peak. So what do you think about as like how long and the upside potential?
I think over the next 5 years, it could be over $100 stock, which its peak was, I think, $86 or so. I didn't own it at that time, but it is a business that can be multiple times larger than it is today. And their margins at their peak their EBITDA margins were close to 13%. Now they're in the 6.5% range because of this challenge that they've faced over the last couple of years. So there's a double, really like a double benefit of growth reaccelerating and margins stepping up, which I think is what's going to drive really strong performance.
Revolve, just for perspective, you said it could be $100 stock, is trading around $23 per share right now. What about, how it sits within that luxury market? There's a big debate going on right now about the luxury trade, and whether it's too soon to get into these luxury stocks. Do you think Revolve could get sucked into that? Or are you pretty firm on your view that it's not the same as like the LVMHs of the world? Yeah,
it's definitely very different from the LVMHs. Like even it's really Revolve as a company owns Revolve, the website, and Forward, the website. And Forward is luxury, but it's more handbag centric. And it's more like accessories to that core Revolve customer. And so that customer is accelerating right now. Like Aritzia, if you look at Revolve and Aritzia's financial results, they move in the same direction because they're really the same customer. And both of them are seeing acceleration from what was a soft environment a year ago. And I think that's going to continue.
Do you own Aritzia too, or you prefer Revolve?
I prefer Revolve. I like the CEOs of Revolve a lot. I think if I'm going to own a company for the next 10 years, I would rather own Revolve than Aritzia, but I think Aritzia is an awesome company as well. And I think management's awesome as well. I just like the Revolve CEOs a little bit more.
All right, we're going to take a quick break and we'll get back to more questions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, our next question is about Wayfair, the home furnished goods online retailer. The stock is down about 40% over the year. Why do you like it? Would you add here?
Yes, I do. I would add here. And the reason why I like it is that they have built a good business. They became really a category defining business within the home goods sector and had a very strong COVID period, which was then followed by an exceptionally weak period in the home goods market. So we're 3 years into annual declines for 3 straight years in home goods. This has not been a good time to be selling furniture. And over that time period, Wayfair has been pretty much treading water, but getting a lot more efficient. And so what I'm excited about and why I think it over the next 5 years is going to be an attractive return is to really show the underlying strength of their business, they need incremental growth because their margins right now, their EBITDA margins are about 5%, but their incremental margins, if they grow 10%, the incremental 10% is going to come at about a 20% EBITDA margin. And so we're waiting on the growth to really juice the profitability and to really get a lot of growth.
Where's that growth coming from?
So the industry has been really challenged. It's been declining double digits for multiple years in a row while Wayfair's revenue has been flat. And so they're actually doing really well right now on a comparative basis and are at all-time high market share. But for them to show that incremental profitability that is going to get people excited and thinking, oh, this is going to be a cash machine, they need to actually grow. And so if the industry goes from -10 and Wayfair's growing is flat, and it goes to the industry's flat and Wayfair's growing 10%, you're going to see a significant step up in their profitability, which I believe is what's going to get the stock on.
So during the pandemic, it was like a $200 to $300 stock.
Yep.
Now it's a $30 stock. Where does it, in your 5-year time horizon, does it go back to those levels?
It can go to new all-time highs.
You think?
Yeah, they need to get back to double-digit growth. They get back to double-digit growth at the incremental margins that they've clearly laid out. The profitability of this business is going to explode over the next 5 years. And I do not see any reason as to why that will not happen.
No. I know you don't really look at the macro, but let's look at the macro for a second. The reason the housing market is struggling right now is interest rates remain relatively high. And so there's just not a lot of activity, right? And if there's not a lot of housing activity, you're not buying new couches, buying new cabinets, all of that stuff. And my question is, if we do see a resurgence in inflation and the Federal Reserve is not able to cut interest rates, so those interest rates are going to stay high.
Yep.
How does Wayfair grow in that environment?
Well, so I would argue like that environment is what we're in today. And their US business is growing just very marginally right now. So the business will grow in that environment. And I think it would still be an okay stock in that environment. But for it to be back to an incredibly strong return from here, like a $300 stock from wherever it is today is like $34. You need the macro to normalize, and so I view it. That's why I like the risk reward, because it's like if the macro stays in this very abnormal environment, then we'll probably chug along here. They'll grow marginally, but if it returns to normalization, it will be very robust.
So it's a stock that can rip if things get even a little better.
Yes.
Our next question is on Monday.com. Why is Monday.com your choice in the project management space? Maybe like a beat on what Monday.com is and why you like it.
Yeah, so the collaborative work management space, there's companies like Smartsheet, Asana, Monday. The space in aggregate there's actually quite low penetration in the space in aggregate. So if you were to add up all of those players, subscribers together, you're going to get to a number like below 20 million users. And there's over 1 billion white collar users in the world. And so I think software solutions like this have significant runway from where we are today. Monday in particular has shown an ability to grow much faster, much more efficiently than the other players. And that's efficiently on several metrics. It's efficiency on sales and marketing. They've been better at marketing. And they've also been more efficient at product development. And that's why now they're like $1 billion in revenue, but they have 30% free cash flow margins, which is very rare and frankly points to how special they are, in my opinion.
What are businesses spending on when they're getting Monday.com software? And I ask that because there's a concern that businesses, if they're spending on tech, they're just only willing to do it for AI, and maybe other things aren't as robust.
Yeah, so it's first off, like Monday has several elements. So one would be they're investing in getting more people to use a solution like this to make them more efficient. Right now, a lot of people are organizing work through email or through Excel, and by using Monday or a Smartsheet or Asana, it typically makes the team significantly more efficient. So that's one element. Number two, they have created other products within in a business that can make them more relevant. So Monday has been, I would say, like the most horizontally innovative in the sense that they start with workflow management on like core business processes. And then they've created a CRM solution. And so that's had enormous success. They've created a developer workflow management solution that's doing well. And then they just started another solution, which is a service desk offering. So they've done a really good job expanding their addressability at attractive price points to their existing customers, which is driving their growth. Then on the AI element, so far there hasn't been any sort of AI tailwind for Monday. And frankly, the collaborative work management space has been viewed as a negative to AI because it's a seat count oriented business. And so people think, oh, well, AI is going to make companies way more efficient. We're going to fire 50% of our staff, and then Monday's going to make less money. But Monday now has launched several AI features that are just starting to roll out now that I think could end up being, could really change that narrative.
All right, so you see some opportunity there. Let's squeeze in one more question in the mailbag before we get to pro picks. That's on Airbnb. What a volatile stock it has been. I think at the end of the year, the last quarter, all of these travel stocks were pretty bullish on growth prospects. I see travel demand's going to be great. Then the last couple of weeks have happened under the Trump administration. I think sentiment is a little bit different. The stock has pulled back. Do you like this stock?
I love the company. I don't own the stock, but it is one in which I could see myself owning at some point in the future. The key holdup for me with Airbnb, a lot of the companies that I own have less mature margins, and the incremental growth is going to come at really attractive margins. So if you're a business that has like a 2% margin, but your incrementals are like 40%, you can imagine if that business starts growing, profitability is going to explode. Whereas Airbnb has 40% free cash flow margins today. So it is already an awesome business that generates tons of cash. And it makes it so that you're much more reliant on revenue growth to drive free cash flow growth. So they're not going to be a situation where, oh, this business grows 5%, but free cash flow grows 100%. It's going to be, if the business grows 10%, free cash flow is going to grow roughly 10%. And so now it's about a mid-teens free cash flow multiple, which is very reasonable, I would say, for the quality of the business. It's just not as attractive as some other stuff I own right now. But I love the company, and I hope I own it at some point.
All right, that's good perspective. Let's get into pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick is Carvana, and I have been just dying to bring this up with you because this has been kind of an insane stock, the most insane stock. It's 20% of your fund, which I also think is insane, and you're going to tell me why it's not. Let's backstory Carvana, the used car retailer. Let's start at the pandemic. What happened in the pandemic? Let's talk about what happened after.
Yes. So Carvana is an incredibly unique business run by a very uniquely talented team. The real backstory is Ernie and several of his founders. Ernie's the CEO of the company. His dad owned a large car dealership. And so he grew up in the business. He knows the car dealership business exceptionally well. And if anyone who's bought a used car would know that the process really hasn't changed for decades, and it generally doesn't make anyone feel good. You usually are at the dealer for a full day and you leave thinking, did I just get ripped off? Like, I feel like I just got sold something and got ripped off. And so Ernie had this view that we can change that by allowing it to be a complete self-serve process where you get all the information online, you know, all the imperfections about the vehicle online. You can fill out all the paperwork online. You can do everything online, and then it gets delivered to your house. If you like the car, you keep it. If you don't like it, you give it back. And so they started the business in 2013, immediately realized, wow, consumers love this. This is a great model. But to build out this business, they have to have reconditioning centers. So when they buy cars, they got to clean them up, get some dents, make sure they're working so they're not going to sell a broken car. And they can't do that in Florida and then sell a car in Seattle. So they had to go on this insane growth tear, frankly, from 2013 to 2021. They went public in 2017 of just expanding across the United States. And when they went public, they had like negative 20% EBITDA margins. And by 2021, at the hike of the pandemic, they were EBITDA break even. And so it was clear that there was really attractive operating leverage in the business. They had grown to become the second largest used car dealership in the United States, not just online dealership, all like second largest used dealership in the US. And their oldest market, Atlanta, had mid-single digit EBITDA margins, which is in line with industry norm, still growing 20%.
So we have all this amazing stuff. And remember, during the pandemic, used cars were they were more expensive than fresh cars because of the supply chain disruptions. Yes. You literally couldn't get one. So that must have helped the story as well.
So that was a narrative at that time. It helped them for about a quarter, but then it didn't, because the thing that people missed at that time was to sell a car, you got to buy a car. So if all of a sudden car prices go up significantly, then everyone's trade-in value assumption is going to be higher as well. So the people who benefited more from that were franchise dealers. Used independent dealers like a Carvana benefited for like 3 months, and then they didn't. And in fact, they actually probably could have grown faster if the pandemic didn't happen, because it was so hard to staff their organization with the social distancing and whatnot.
So the market had a different opinion of that.
It did.
Because the stock peaked in 2021 and then proceeded to fall basically 100% over the next year and a half. Wait, I'm not finished. And then call it beginning of 2023 to where it is right now, it went up by 4,600%. Yeah. Okay, so it fell almost, and like when it fell, the obits were being written, bankruptcy filings, everybody moved to sell, and everybody just said Carvana is dead. It might not be able to continue.
Me and a few people did not say that.
And I want to know about that. And I think when you talk about the CEO, this wasn't just a CEO, this was a founder.
Yes.
And, a family sort of tie-in there. Yep. I feel like this is where that situation matters, right? Because it wasn't just a CEO who's like, okay, well, this didn't work out, and I'm going to go be a CEO of another company.
Yes. So I asked Ernie, how did he, during this 2022 period, if you look at most growth-oriented companies, the ones that 2022 killed them, obviously all the management team left and changed. Even the ones that that had a turnaround, most of them had significant turnover in their executive ranks. Carvana did not have all the core people that ran Carvana, from when it went public, when it was a $10 stock to $300, all the way to when it hit $350, and then now it's at over $200. All of those same people are still there, and it's because they really believe in the model. They know the model works. The online used car retail model is a better model that still only has 1% market penetration, and it's a better customer experience. It's more profitable, and they have so much runway. They all believed, and frankly, they all bought stock. So Ernie, all the other executives were buying stock at $20 and below. And then if we've seen the results over the last 2 months, what's happened is that people went from thinking this business doesn't make a lot of money, the economics don't work, which I knew wasn't the case, because pre the collapse, we knew Atlanta was already very profitable. And then now it is the fastest growing, most profitable used car retailer in the United States.
There was a short report. Hindenburg came out with a short report alleging all kinds of financial chicanery. What did you think of it?
All of the points they made are points that other short sellers have made many times since they went public. All of them, shouldn't say all of them. None of them are points that I think are a concern to the long-term investment thesis. And I think most of it is just trying to spin a negative narrative about the business. The management team is very aligned. They are exceptional. Everything they've done has been to the benefit of shareholders, and they have an incredible business.
So what I want to know is, when did you get in?
It was when we launched the fund on March 1st of 2022, it was the smallest weight in the fund. It was a 2% weight in the fund, and our first buy was $128. Then the market obviously got very scared in the May, June timeframe of that year. Stock goes down to $40. We buy more. Then it goes to $20. We buy more. then all of a sudden people think they're going bankrupt, and there's articles being published that I factually knew were not correct. Like things they were saying, oh, this business is going to run out of cash in the next 3 months. Like it was not possible for that to happen. And so our lowest buy was $7. And our average cost had to be around $30, and now it's a $200 stock. And I think it's going to go to $1,000 over the next 5 years. It is like an Amazon. The only difference between Carvana and Amazon is that when Amazon was at a similar level of market maturation, their margins were much lower than the industry norm. Carvana now is 1% penetrated, but they have double industry margins and are growing 50% top line right now in an industry that's flat.
And so fascinating to hear you say that this could be $1,000 stock, especially because there's been so much volatility because of the pandemic, post-pandemic. Mm-hmm. Let's bring that narrative to your second pick, which is HelloFresh. Everybody was doing HelloFresh during the pandemic. And then we could go to restaurants and we could do other things. Things started to open up. So HelloFresh went from being, like a €90 stock, I should say, because it trades in Germany. And now it's below 11.
Yeah. So HelloFresh has a similar, you're going to see some rhyming going on here. HelloFresh has a lot of similarities with what happened with Carvana to some degree. They are run by an exceptional founder who's done an exceptional job building the business. But as you probably know from your own personal experience, a lot of people used meal kits in the pandemic, and meal kits is a high churn service. So if 100 people buy it in the first year, a year from now, it might only be 20% that are actually still using it, still making profit for the business, but that churn impact has an impact. And so during the pandemic, they went to the moon. Then they had to lap that, which caused pressure in the meal kit business. But at the same time, they bought another business called Factor 75, which you may be aware of because they've been marketing a lot in Canada recently, is a ready-to-eat meal. So it's fresh meals that you can throw in the microwave or throw in the oven. And they have become like the market leader in that space. And that business has been growing a lot. And so over the last couple of years, the business has gone from growing like a weed to pretty much flatlining. And the margins have gotten incrementally more negative because the growth has been driven by a younger business, a Factor, while meal kits is finding out the floor. And they were holding on to, we think meal kits can still be a growth business. And so that's what people were very skeptical of. And that's why if you look at the stock chart, it was like in the $20 to $30 range for a while. And then at the beginning of 2024, they finally came to terms with that the meal kit business is a mature business and they need to operate it as such, which means that there is a lot of profit to unlock of this business. If we're not trying to grow this 5% anymore and we're accepting this is mature, we can improve the profitability of this dramatically. And so over the last year, it's been like this huge efficiency kick. And at the same time, the ready-to-eat business is still doing really well. But everyone like lost faith in them pretty much when they said this. When they said, all right, guys, like meal kits, we're accepting it's not going to grow. It was like haha, we told you. And anyone who was believing them said, we're out. And then everyone who was a short seller who was like, we told you, is like, haha, we were right. We were vindicated. And so the stock has really been like it's really been dead for like a year while they're in this mode of, we got to prove this thing could be highly, highly profitable. Over that period, they've bought back 6% of the company through a share buyback program. The CEO took out a 10 million euro loan to buy more shares. He owned 4% of the company before. Now he owns 5%. And every quarter since that like disastrous moment, they've showed increasingly better profitability numbers. And I think that's going to continue. And I'm very excited about that.
There's Canada's Good Food as well. Is it a similar story, or you prefer HelloFresh?
I prefer HelloFresh in the sense that HelloFresh benefits from being so large. So if you look at HelloFresh's competitors in every country, there's usually a local player like a Good Food. And those businesses are fine businesses. And I think Good Food is run by some really smart people. And I think they have a lot of opportunity in the future to grow as well. But HelloFresh is like the de facto dominant, like 800-pound gorilla of the industry. that has a unique moment currently to dramatically improve profitability, which no one is giving them any credit for. And so my forecast over the next 5 years is that they grow revenue 5% a year. So I'm not saying this is going to be some sort of like crazy grower. It's 5% a year, but at the strong incremental margins that they've proven in their oldest markets before, which is going to make EBITDA go from a 5% EBITDA margin to a 10% EBITDA margin.
So it's like a profit inflection story.
Huge profit inflection. That's the thesis, is the profit inflection.
Okay, so continuing the theme in their pro picks, which is pandemic roadkill.
Yes.
Picking up pandemic roadkill. ThredUp is your third pick. This one down massive from where it was in the pandemic. Used clothes?
Yes. So ThredUp is a really, really unique business. So when it went public in 2021, I was like, this is an interesting company. There's a lot of different used clothing marketplace apps. Like there's a lot of people on Instagram, on Facebook selling used clothes, running these little shops, or on Poshmark, Depop. There's a bunch of these different platforms. All of them are the same in the sense that they aggregate users and charge a commission. So they're not actually helping you operationally in any way. They're just, this is an app that people come together and transact on. ThredUp took a different approach. They thought, okay, people who take stuff to Value Village or Goodwill, they're doing that because they want it out of their house. They're not trying to like make an extra $7 by loading a picture online and selling it. They want convenience. And if someone could give them some money for it and it'd be incredibly convenient, they would probably do that. And so what ThredUp did is they had these ThredUp clean out kits, which are effectively bags. People could have the bag sent to their house. They fill the bag up with clothes that they don't want, that they want some value for. They send it to ThredUp's warehouse. ThredUp has a warehouse. The ThredUp opens the bag, looks at the stuff that they can sell. Stuff they can sell, they throw on a mannequin, they have to do all the processing, then they throw it on a conveyor belt, and it sits in their warehouse of millions of unique items that then people online are shopping for. And so that, like, the unique thing about ThredUp is that they're tapping into supply that isn't going to be sold.
And then what's their margins? Like, what do they get?
So that's why the business is so interesting, because that, like, what I'm describing is like, how do you make money sending them a $40 used sweater? Like, you got to pay freight to the warehouse. You got to have someone take it out, put it on somewhere. You got to store it, and then you got to send it to someone's house. And so historically, the business was not making money. In 2021, they were just focused on growing as fast as possible. They weren't making money. And then 2022 happened, where all of a sudden every shareholder just jumped ship and they realized, okay, well, we need to get to making money and prove that this economic model works. And so they had been on this like efficiency kick for 2 years. And went from not making money to being just about adjusted EBITDA break even. And to do that, they really would have had to show like very attractive incremental margins, which really proves out that this business can make a lot of money at scale. And so that process is now like, it's at an inflection now where they just started inflecting revenue at really attractive incremental margins, and they're now at a point where they're going to start generating like meaningful amounts of cash. And it's, people are going to look at it. I'm saying this now. I bet you majority of people have not heard of the company.
I mean, I don't know if I'm going to buy the stock, but I'm going to go to ThredUp because I've been answering the same question about the same dress I've had on Facebook Marketplace for like a year, and it's just not moving. Yeah,
well, you're not going to be able to sell it because they don't operate in Canada right now. But
they don't. Okay.
Yeah, they're only US based, and they are solely right now focused on scaling what they have and showing that they have a really economic business. And based on the current share price, that is not the belief at all. If I told someone to look at the historical financials of this company, they're going to pull them up and say, this looks awful. But it is at a very, very critical inflection where incremental growth is going to come at very attractive economics, and it's going to bring this company on people's radar, because all of a sudden they're going to say, oh, this is a small internet company that has like true differentiation, because to build out what they've done, you have to open these massive fulfillment centers and figure out how to operationally make this work, which is really, really hard. And so that's why I like it so much.
This has been so fun. Thank you so much, Jordan, for joining me.
Yeah, it's been fun. Thanks for having me.
Some optimistic perspectives out there, even though there's a lot of pessimists out there. Make sure you tune in to our next episode. Follow us at In the Money Pod anywhere on social media, and you can see what's coming up next. We'll catch you on the next episode.